Hello and welcome to our end of April update from the Wealthy Doctor Institute, Intelligent Investing for the Busy Professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those of you who are new to the concepts of this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So for this month, we're going to go through the topic or lesson of the month, then review our 20-month simple moving average system, review the MRI system, remind the rules for the 25% stop loss system, and finally remind ourselves about the sector surfer systems if you're following it. So for this month's topic, one frequently asked question is, have I seen the Big Short movie? And no, I've read the book, but I've never seen this movie, but I've been asked so many times that I finally just watched the movie this past weekend. And although I appreciate the sentiment about why people recommend this movie to me, there are lessons that we can learn from this movie, and they're not what you think. So The Big Short movie is a movie about investing, particularly about what happened during the credit crisis of 2007-2009, what led up to it, and who actually saw it coming and did something about it. Namely, bet against the economy and shorted whatever it was that was tanking the economy or was going to tank it. So it is an exciting movie compared to the book. But some of the lessons that we can learn are, most people can be wrong, particularly when it comes to market forecasting. I mean, no one could have foreseen that something as solid as real estate could possibly tank. And when that tanks, then the whole economy could tank. It was unthinkable. And yet, there were few people who actually saw it coming. And recognize that an opinion that is not recognized mainstream, no matter how correct, can often be rejected by the mainstream. So when you have a couple of people who notices something off and are convinced that this is a ticking time bomb and tries to warn people or try to take advantage of it for their clients, well, they're often ostracized. So for us little guys, sometimes we can be correct as well. And yet, even though we know for a fact that the markets are going to crash or whatever, the markets can stay irrational longer than you can stay solvent. So the heroes of the movies went against the market consensus and they suffered criticism for it. And when the heroes' predictions proved correct, the markets were still manipulated against them. So the Big Short movie has fallacies. So the heroes held on to their positions no matter what. So no matter what other people said, no matter what the markets did or didn't do, even though they were supposed to crash, they did it and they got lucky. Realize that for most investors, no matter how correct we think we are, there's always a chance that we could be wrong. And to hold on no matter what, that's a recipe for disaster most of the time. So, no one knows everything about the market. Everyone needs an exit strategy. Be humble to realize that we could be the one that's wrong. And even if we are right, the markets can occasionally be manipulated. So how do we know when we're wrong? And what has to happen so we know what to do about it? We must answer this question about the exit strategy before committing a single cent to the markets. So do not follow gurus just because they sound so sure about what they're doing. Not even me. Always be sure there's an exit strategy somewhere. So at least when I explain how to invest, I always emphasize know your exit strategy. So The Big Short was good about certain things. They did explain things like mortgage-backed securities, CDOs, credit default swaps, tranches, etc. Albeit simplistically, at least it helped the audience understand what was going on. And also, what I like about this movie is that it touched on these massive conflicts of interest that exist in the investing world, which are unfortunately accurate, which kind of, if you think about it, is unusual because for us little people, when we have financial advisors, we are subject to all these rules and regulations that are built to protect the investor. And yet, on the big picture, you can have all these really obvious conflicts of interest that can hamper the safety of the markets. So another truth is that when the shoe shine boy, or in the case of this movie, the stripper, starts getting in on the action, in other words, investing or taking out mortgages like crazy, it is likely time to seriously reconsider the rationality of what the mainstream is doing. So are there everyone knows it warning flags when the cover of business magazines start touting the end of the dollar or the big bull market in real estate? It's usually the end of a trend. Similarly, rating agency ratings can be inaccurate. Like, for instance, everyone knows about how one-star Morningstar mutual funds tend to outperform the four-star Morningstar mutual funds. Alright, so now let's review our systems. Remember, our systems objectively look at the footprints of every trader and investor in the markets through the market charts and let the markets tell us what to do. None of this forecasting or guessing and, can we be wrong because our own emotions or our own overthinking gets in our own way. So the first system is the 20-month simple moving average system. The rules are simple. If the price of the S&P 500 index fund is above the 20-month moving average, it's relatively safe to be invested in the fund. Otherwise, get out. The 20-month moving average is our safety belt. It only works if we watch it every month. So, for instance, here's the updated graph. The VFI index, or the S&P 500 index fund ticker symbol, at the end of the month was 220.27, and the moving average is 195.49, which gives us a similar 12.7% cushion similar to last month. So both the market and the simple moving average went up. That's good for us because with this system we're still in stocks. So let's take a look at Sector Surfer's StormGuard Armor, which is another way of looking at whether or not stocks are relatively safe or dangerous. According to StormGuard, we've stayed in the S&P 500 Index Mutual Fund this past month and have no signal to exit yet. And so here's our StormGuard Armor indicator. It's still positive, saying it's relatively safe to be in the markets right now. So next system is the Monthly Rotation Investment System, abbreviated to MRI. So with this one, all we're doing is ranking the three funds, the S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund. Sell the bottom 25% of your portfolio and buy the top fund every month. So this month, last month's prices, this month's prices, the S&P 500 index went up 1.02%, but the emerging markets went up 1.39%, and of course the inverse went down 1%. So you can see the graphical representation of what the markets did in these three funds for the last month. There's a clear winner, although it barely edged out the S&P 500 index, but the emerging markets is still the winner. So under the current model, as of last month, we were 100% in the emerging markets fund. And so this month, we're still in the emerging markets fund. So let's take a look at how Sector Surfer looks at those same three funds. As Sector Surfer rotates among these three funds, we see that we've stayed in the S&P 500 index fund. It looks like the S&P 500 did better than the emerging markets, but realized that I can't start the graph at April 1st. It starts exactly 30 days ago, and this was a short month. So observations, the emerging markets continue to edge over the U.S. large cap stocks, namely the S&P 500 index funds, and sector server still has not triggered any switch, which, remember, it's a different algorithm, so don't mix up the systems. Don't say, oh, I'm using MRI and I'm staying in S&P 500 index. No. You're either using MRI or you're using sector server. Don't confuse the two. So other systems we're monitoring, the 25% trailing stop system that we use for individual stocks, and remember to monitor your own sector server strategies. So to recap, their 25% trailing stop loss system is what we use when we really want to invest in a stock for some reason, individual stock, not an ETF or a fund. So if you really want to buy a stock, you want to limit your portfolio to just 1% in any one position stock. That's because each stock has idiosyncratic risk. Overnight news can tank a stock before you can sell it. So, if you're going to have a 25% trailing stop loss, you can use 4% of your trading account to buy that one stock. This way, when you lose 25%, you only lose 1% of your portfolio. Make sense? So if the stock goes up 33%, now the trailing stop loss is at break even, and you can go ahead and buy another block of 4% of your account in that stock and update your trailing stop loss order to reflect the increased number of shares. And keep doing that until you get stopped out. So the next system is your own sector server system. Remember, every system is different because I don't know which funds or ETFs or whatever you put into your system. You have to monitor it, or rather, sector server will text or email you alerts, but it's probably a good idea to log on every so often, just because I'm anal and I like to make sure that technology, which is not always reliable, doesn't slip a signal by me. So sector server, remember, has two main tools. It has both an indicator, namely the StormGuard armor, to help tell whether or not stocks are relatively safe or dangerous, and then uses a sector rotation system to optimize which particular funds you may want to put in during the bull markets or the bear markets. So if the sector server strategy is set up properly, you will get a signal through email or text, but log on periodically. I do it once a week, but for this video, I do this once a month. And for this month, we remained in a safer stock zone, but unlike the MRI system, we stayed in S&P 500 index fund as the stock fund of choice for now. So I think it's a good idea to at least follow one of these sector server strategies so you get to know what I'm looking at when I'm following these sector server strategies. So remember, when you sign up for a free sector server account, it will give you a free strategy. So I'm not revealing anything proprietary by going over this free strategy. So those of you who have accounts, you have this free strategy, unless you delete it. And this weekend, we just got a signal to get out of the VUSEX and go into the FWWFX. So if you take a look at the last 29 years, we get this yellow line. It's been going up for the last year and a half or so, which is what tends to happen when you detect the market leaders and rotate into the market leaders. Now, as you tweak your own systems, you may notice all these numbers here and all these graphs and charts. I can go over a few that are useful to take a look at, like for instance the safety score. Remember, we're safety first when we're investing, and the safety score is nothing more than the Sortino ratio divided by his relative risk. These are just measures of risk, and just keep in mind that a score of 10 or more is relatively safe. So if you take a look at this example free strategy, It looks like it does well, but we can construct something that's even more safe. In other words, the chances of losses and the amount that we would lose in a maximum drawdown are historically smaller than this free strategy. So, in summary, we've gone over different systems. They all have different rules. Don't mix them up. Keep them separate. We've gone over the 20-month moving average system, the monthly rotation investment system, the sector server versions of the system, dealing with stock tips, and then monitoring your own sector server strategies. So keep those questions coming. I know I talk to several of you personally every month, but for some of you who have only heard about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague, here are ways to get in touch with me. Seriously, drop me a line, give me a call, email me to set up a consult. A few of you I've talked to, you know your stuff. I'm not worried about you. But for some others, holy cow, it's clear you need help getting your financial life in order. Don't be bashful reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely.